Welcome back to Making Money Matter. I'm your host, Kerry Stevenson. Today I've asked Hedley Widdup to join me. Hedley Widdup is with Lion Selection Group, which the ASX code is LSX, in that order, LSX. He's based in Melbourne. I'm up here in Queensland. The joys of Zoom means that we can have a conversation and bring it to you, our wonderful audience. Now, one of the things I want to talk to Hedley about is he's got this clock. It's called the Lion, what's it called?
Hey, Kez, thanks for having me. It's called the Lion Clock. So you could probably even Google it, and I reckon you'll get some pictures of it.
Yeah, and it's great because what it does, ladies and gentlemen, it's a clock, and it basically goes around and says, where do we think we are at the moment? And that's what we're going to talk about today. A lot of confusion in the market, but Lion Selection Group, they've got about close to 70 mil looking for a home in a falling market, which is really interesting. So we'll talk a little bit about that. We'll talk about gold, silver, lots of other commodities, just to help you, the audience, understand a little bit more about how to select what you're looking at. It's not financial advice, by the way, ladies and gentlemen. You've got to go and do your own research. I always tell you to do that. But Hedley is very well versed. He's been with Lion Selection for 17 years. So we're going to have a lot of fun. Hedley, always great to see you.
Thank you, Kez. Nice to see you as well. We've caught up many times over the years at some of your events, and I have some very fond memories of the companies and people that we can talk to and catching up with you. So thank you for talking to me today.
Oh, and I remember way back at Broken Hill was one of our forays, but no, we're not doing Broken Hill. But hopefully we'll get you up to the Gold Conference in Sydney in late August, ladies and gentlemen. Go to goldevents.com.au and register right now. It's going to be a cracker of a show. We're going to talk about gold in a minute. But Hedley, I said just now that Lion Selection Group's got almost 70 million cash to invest. Why? What are you looking at? Are you staying on the sidelines? What's your view of the market right now? Confusing is what I would say.
Well, we're an investor first and foremost, and that's what we've been classified as forever. But we deploy capital. Lion Selection Group's a listed company, and we deploy capital over time in much the same way as a mining company would into the best opportunities that we see within our potential portfolio. And so the difference between us and a mining company is that anything which is a company which will take our money is a possible investment. So we don't have to own it in order to invest money in their projects. And we see it as deploying into what they're going to do in the next 6 to 12 months. And then, following those projects if they turn out to be good. So we are looking in the junior and micro capitalization end of resources. That's what we've always invested in and where we've had a great deal of success. And between, let's say now and 2 years ago, the cash that we've got has probably over doubled in terms of purchasing power. So we've invested a little bit of that, but that 70 rump would have bought half as much 2 years ago as it would do now. Maybe even better purchasing power accretion than that in that time, because the sector has really fallen heavily.
Speaking of the sector falling heavily and the Lion clock, where are we on the clock right now?
So the clock is a concept that we've used. In fact, it predates Lion. My father was the founder of Lion, and the clock is a concept which he used as a broking analyst before Lion. The mining industry is incredibly cyclical. Commodity prices go up, commodity prices go down. Mining equities move up and down to follow. And as that clock goes around and around, money moves into the sector. That's what drives a boom in mining equity prices. And then money moves out of the sector, and that's when it becomes hard to raise money. So you have a crash, if you like, which starts at 12 o'clock midnight. It's kind of based around the Cinderella theory of the party stops at midnight. That we call it a crash, but that down cycle can be instantaneous, as it was in October '87, or quite obvious as it was in the GFC, or it can be a bit more of a slow burn, like we saw in 2011 through to 15, and as we're seeing now. I mean, the down cycle hasn't been felt as strongly by someone like BHP as it has been by XYZ Exploration Limited. So we're in a down cycle now. We say it's 2 o'clock, and the boom, if you like, starts. So you go through the bottom of the market at 6. Those hours don't move at a standard pace. So we could be at 6 o'clock in a couple of minutes' time, just by a couple of things changing in the global economy and the global equity market. I tend to think it won't be so quick, so it can play out over time as well. But just making the point that booms tend to last longer than busts. but on the
Okay.
clock they're kind of 12 to 6 and then 6 to 12.
So we're at 2 o'clock, which means we're really at the start of a falling market. But I would also possibly point out to people is you don't want to be possibly looking at things at 7 or 8 or 9 o'clock. You actually want to start looking at things at 2 o'clock. So it potentially is a good time to be looking at things.
Well, if you're an investor in equities, you don't want to be trying to perfect your entry to pick that absolute bottom, because, well, you can say all sorts of things about the smell of fingers if you're a person who picks bottoms, but if you are waiting a moment in the market and want to align your entire investments to that, you are guaranteed to miss it, because human beings are so fundamentally wired to interpreting things in straight lines. It's really difficult to see turning points, even if you think you're looking for them. So our philosophy at Lion is that as that market is weakening, you tend to see those opportunities moving into the value range that you're happy to pay. And then because you're investing and us with sort of institutional scale, I suppose, of support, can help to steady a ship, so that if they don't have to worry about funding as much as other companies do, then they can outperform through the weaker parts of the market, which means that if we're investing through that down cycle, it's the very best time to be placing our bets, because they should get most strongly re-rated on the other side of that.
Speaking of doing that sort of a thing, what do you look for, Hedley, or your team? What do you look for when you're looking at investments? Is it management? Is it jurisdiction? Or is it a combination of a lot of things?
It's a combination of a lot of those things. For many, many years, Lion had an investment mandate, if you like, which would allow it to go into lots of foreign jurisdictions. It started off being a Australia, Africa, Asia mandate. It became global at one stage. Right now, we are looking in Australia and Australia only. And I suppose I'll just boil that down to being as simple as, if you want world-class geology, sometimes you have to go overseas to find it. But the problem with going overseas, particularly when you're finding world-class geology that hasn't really been touched, is that there's often a reason for that. And it might be a really crappy, local economy. It might be an unsafe jurisdiction. It could have horrible government regulations. It might be a very difficult place to protect yourself as an investor. So Australia has so many things going for it in terms of money and security, that it's just a far easier place to look. And when you look at investment returns on equities, you can get fantastic returns off of a sensible strategy on, I suppose, what you'd call moderate to okay assets in Australia, that beats world-class geology in foreign jurisdictions that we've dabbled with in the past. So very, very comfortable to be executing that strategy just in Australia. But more broadly than jurisdiction, we've always focused on people and project. And, that rolls off the tongue so easily, doesn't it? Everybody knows that people are an important part of the equation, but I've always found it amusing that every single presentation you see at any conference, the managing director or CEO standing up there going, "Oh, we've got the best management in the business." And it's like, "Oh, okay, you do too." So across the sector, if you did a quick survey, which was based on presentations, you'd find that every junior company has outstanding management. Yep. And I don't think you actually see that in BHP or Rio Tinto presentations, but, I wouldn't say you could generate a comparison, but, I think you need to look more deeply than how they describe themselves. And to us, the ability to have a level conversation where you feel like nothing is being hidden, and the ability to understand that they understand their business is crucial to us. There's no point backing someone who is just a good storyteller. That can be a very important part of the value equation playing out, but being a storyteller can also mean that you're capable of believing your own bullshit. We want to back people who are technically highly capable and honest at the start of the day, and we can play a part in helping them to promote their businesses, no problem. So you want to avoid the pure promoters. They might be good for a trade, but through the cycle, we're going to own 5, 10, 15, 20% of these companies in some cases. So we need to know that they're solid through the cycle and not just for a good time. And when it comes to project, we're after all manner of special things there, I guess. We're investing pre-production, but we're looking for something which is a developable project if we're going to be putting millions and millions of dollars into it, and have a value case which we can have. Well, I suppose in the business they call it a high conviction situation. I think of myself as an executive who's deploying capital as a mining company would, and no one talks about high conviction in mining. That's a funds management concept.
Yeah.
We're looking for things that we think have an extraordinary value equation. So a project which can be of a strategic size with a very defendable cost base, and in a commodity where we feel very comfortable. Now, we'll make exceptions to that because as you go through looking for things, you sometimes find things where you think, well, this is extraordinarily cheap. It could be a high risk proposition, but it's cheap and it has an extraordinarily very, very, very high level of payoff if they get it right. So from time to time, we do things like that at the moment. So we've deployed into 4 or 5 things in Australia in the last 2 years, and 4 out of 5 of those are projects with people where we feel that equation is right. Okay. The fifth of those is something which is the latter that I described, which is there's a great deal of uncertainty about what it might turn into. There are some exceptionally good indicators, but it carries a lot of exploration risk. But it has, if they get it right, it's a district which has been discovered. You're shining a spotlight on a part of Australia where nobody's thought about gold or copper before if they find something. So we try to build that into our portfolio, because if we risk $1, $2, $3, $4, $5 million of investment, that's not our balance sheet. It's well less than 10% of our balance sheet. But at the end of the day, it could be the sole thing which is responsible for doubling the value of Lion. We see that as being an exceptional opportunity to be able to get involved with, particularly given that it's a situation where the people there we can work really closely with, and so it's almost like we become a part of their team and vice versa.
Which is handy to have. If I could just go back a step, you talked about meeting with people and asking questions. I think it'd be really good for our audience just to hear sort of, a lot of them will go to conferences. I've just come back from the RIU conference in Fremantle, which was fabulous. But when you're going up to a couple, let's just and do an imaginary conference, and you're walking up somewhere, what sort of questions do you think people should ask? Because I think half the time people don't know what to ask, and especially if people don't understand mining.
Yeah,
they've got money, they want to deploy it, but they're too embarrassed to even start to ask the question. I'm all about educating.
I think this is a really interesting thing, right? Because I speak to these people all the time, and in a lot of the time they're calling us up. So you get over they're a CEO of a company pretty quickly. You're not talking to someone who's the CEO of BHP and has minders all around them, or might even treat you with a bit of disdain if you get the question wrong. The people that you're talking to at these conferences, I mean, your event, Kerry, on the Gold Coast is a fantastic one for this.
No,
because I think
it's not on the Gold Coast. It's in Sydney.
No, in Sydney.
I live on the Gold Coast. Let me just make this very clear, ladies and gentlemen. Keep calling him out. It's the Gold Conference at Crown in Sydney. I live on the Gold Coast. Sorry.
In August. And the companies which come to this, these CEOs come prepared to talk to investors. That is the reason that they come, is to have these conversations. So when they have 2 and 3 deep at their booth with people wanting to talk to them, that's them getting value for money. And so they have this expectation that there could be any and everything. So I don't think you need to be at all concerned about what your question will be, because in a lot of cases these guys get, well, I can tell you, I've been present when there's been fund managers or brokers asking questions which genuinely are inane questions, because they're supposed to be sophisticated, and they're asking things which these guys get quite wound up about because they're off the topic or really not relevant. But I think someone who's coming at this from I'm an investor across the market, I manage my own money, and I genuinely want to know the answer to this because it's important to me, should just have that at the front of their mind. That's the basis on which you ask these questions. So if you want to know the answer, you ask the question.
Yeah, but what's the question? That's what.
Well, a good one to start with. A good one to start with is when you're talking to this chief executive, say, can you tell me what attracted you to this situation, this company in the first place? Why did you join? Because that covers so many things. If they're a founder of the company and they've brought in assets, then you're going to get to the bottom of that pretty quickly. If they've just been recruited 6 months ago, equally you will get that background, and that background is pretty useful. But it also gives them an opportunity to get off the topic of, I'd like to know about your resource, in which case they'll kick into, it's this big and it's this great and it competes with everybody else. they need to tell you what they see in the company, which is the best possible selling point. So, and what you're expecting in an answer there, if you're still talking to them in half an hour's time and they actually haven't answered something, you might think that it's a person that gets off the topic quickly. So you want them to give you their key selling points, which they might not even have thought about at that high level, but it's a good test to see how quickly they can think on their feet and how much they have that company value equation front of mind. Once you've had that question, you really want to know about the assets, and you really want to know how they're going to fund themselves over the next, I don't know. It's a general template question, this, but you're not going to talk to anyone at these conferences who has a fully funded production proposition in front of them. Most of them are going to be wanting to develop something. So the question for them is, look, if you've got that interesting a project, how do you see you being able to fund yourself from here? And could you answer that in the context of your market capitalization at the moment, the capex that you need to fund, and the split between equity that you need to raise in the market and debt that you might be able to borrow? And these are things they're quite capable of answering. They might feel a bit uncomfortable and want to steer around a few things, but if you're after a genuine answer and you don't think they're giving it, the third question, which you can never ask them, is, are you a liar or not? And you will be able to make up your mind by the end of that conversation as to whether you think they're the kind of person who can, they've got to be able to communicate it to you. And if they can't get those ideas across in a way which is convincing, then you've probably answered your own question about whether I want to hold this equity or not.
And I think if I could just add one to that is, guys, before you go to a conference, study a little about body language. Because Hedley just said it, you don't have to ask them if they're a liar. Check on their body language, because that will tell you a little bit as well, won't it, Hedley?
It would. What you got to bear in mind is that these people haven't gone through a psychometric appraisal and 20 years of due diligence as you would to become the polished presenter that leads a global major company. In some cases, they're founders, and to be a founder of a company like one of these ones and have something which is genuinely special, they might have odd quirks as well. So I'm a little bit forgiving, or quite forgiving, of this, because some of the people that we've worked with over the years who have had something genuinely special have also had, they might get nervous around big groups of people,
right?
Or they're far more comfortable talking to rocks, which backing someone to develop a project, you want them to be a little bit more gregarious. But in order to pull that situation into one place and give yourself the platform from which you can succeed, sometimes it's someone who you need to forgive some of those foibles. So, but defensive body language is the thing you need to be very alert for. So, yes, that's the thing you worry about a bit.
Really good information there, Hedley. So let's go more into specific commodities. Now, about a year ago, the EMs, lithium, I know, because there's a chart I noticed on one of your presentations where from 2018 to now, and back in 2018, lithium didn't even exist on the chart, and now I think it was gold and others. Now it's gold. Lithium's like 8 or 9%. Now, 82,000 back then, about 14,000 now. Is the party going to start again? Do we get the party started, or is it all over?
Well, lithium's something which has come from nowhere as far as the mining industry is concerned, and equity investors are concerned. So, they've had to educate themselves pretty quickly, if you like. And if you took any point in time over the last 5 or 10 years of breathless lithium promotion, the conviction story which you're being told about how that's going to go into batteries and play out into price has either been really, really right or really, really wrong. And the problem is that, the longer you extrapolate your observation period, the wronger you get, particularly when you're talking about, we need batteries, that demands a lot of lithium, that's going to be good for price. Because sooner or later, there's, supply comes into the market. So I think with lithium, it's a fascinating one, because it started as a really small commodity market. I mean, the biggest commodity markets in the world are things like gold and iron ore, and lithium is an absolute tiddler compared to those. So you bring on new projects and you cause a disruption in price just by doing that. And we've seen plenty of that in the last 12 or 18 months. The other thing is that it went from being a really obscure small market to one which people think is a bit more mainstream, but it's still quite obscure. The notion of spot price, the way that things are traded, the value of a cargo based on its purity and its impurities, all things which contribute to what ultimately a revenue figure will be and how that translates into the real performance of a miner who is producing lithium. So I think you can say with confidence that lithium appears to have a very important role to play in the future of battery technology. And I know, there's arguments about sodium technologies and lithium technologies. And look, that's a real consideration. But at the moment, you've got to say lithium has the ascendancy. It's been very strongly promoted, particularly by some of the end users. So if they were to pivot, they're going to have to reinvest in that pivot. And they need to make a very, very large CapEx decision in order to do that. So, is it the VHS or is it the Betamax? I tend to think that at the moment it's the Betamax. It's the VHS. And sodium technology might be superior in some ways, but it might be the Betamax of the battery world for now. Now, you can't just adopt that analogy and run with it, but it's a useful way of considering it for now. I think the other thing, as far as lithium price goes, is that when it was at the heights of, I think it was 2021, and the reference price you can get via an IRIS system or something is lithium carbonate pricing. It doesn't impute the value for a cargo of spodumene concentrate, which is what you would see people talking about exporting it from Australia, because that will be adjusted for whether it's a benchmark 5.5 to 6% concentrate, or whether it's a 1.5% DSO product. But there's a reference which is reasonably usable there, and over time the lithium equities approximated that lithium carbonate performance price. So there was a connection in terms of sentiment there. But at the peak of that market, you had very, very unnatural, I would say, margins going to the producers of lithium spodumene concentrates and to the DSO producers. I mean, if you could make money off of what I would say through most of the market could be regarded as a shitty cargo, if you can make a really good margin off it, it tells you that there's an unnatural price there. And over time, as buyers and sellers come to know each other's behaviours and more production and more demand comes into the market, the opportunities for those huge margins, I think, are probably less likely. So, to me, the lithium price might still have some opportunity from the level that it's at. I certainly don't see it staying where it is forever, but I don't see it reapproximating the levels of 2021 at any stage in the near future. So I was talking to someone last night on the phone, and they said, "How do you feel about lithium?" And this was a person who likes fund manager speak. So I said, "Look, I'm very constructive on the space," and I think that means that captures. I think it's a good time to be looking for opportunities, but I'm not about to plunge into something constructive. It's a bit more, I think, long term in terms of the implications. So I'm looking at a lot of lithium opportunities, and I'm thinking about them deeply, but I'm not doing anything precipitous or large at the moment, because I think there's a while to wait and see how it plays out. Particularly in terms of some of the explorers getting a bit stressed about where the next lick of cash comes from.
Why do you think the market is, I guess, it's a confusing market, or it feels that way to me? It's a little bit, what's the word I'm looking for? It's a bit of this, it's a bit of that. It doesn't know what it is at the moment. What's driving that? Because I know the psychology of markets are important. I remember James Dines wrote a book all about the psychology of markets, and it seems like it's either everyone's going all in or they're going all out. And right now, I'm not quite sure which way the tide is flowing. What's driving that, Hedley?
Well, I'm a geologist, so that's the disclaimer at the start here. You said do your own research, and some of those things should also say don't listen to geologists. So if this is a good story, good, but you satisfy yourself as well. And I think that when it comes to equity markets, I mean, my observation, having worked as an investor for, well, you said 17 years, so let's say it's that long. Markets are driven by bright lights, particularly when you think about micro cap things. And they can really lunge at something which is illogical, but append great value to it. I mean, tech has been something over the history of stock markets, which extends over 400 years, which has fascinated people, and they've always been happy to pay an enormous premium for a good concept. I mean, two-wheel bicycles, canals, railways, .com era, and then things like artificial intelligence have attracted. They really ignite the imagination of markets, and there's a big crossover of that goes into commodity speculation via equities as well. Because if you've got a good story, that same phenomenon can be a part of the way that it works into your equity price. But I think the confusion at the moment, which a lot of people experience, is that high-level indices seem to be going sideways, or they might go up, but you've just got this feeling that earnings haven't really justified that. There's this push and pull between what interest rates might do, and interest rates are one thing which sits absolutely beneath the equity market as an ultimate driver, because if there was a perception that interest rates are going to go from 5% to 10%, then why on earth would you hold equities? You'd put everything into an interest earning product and just collect that money for zero risk. But there's no conviction about where interest rates are going to go at the moment. If we went back 18, 24 months, we've gone from virtually 0 to 5% in that time. And I think there was a sentimental pullback on that was, well, surely it can't get to 2%. Surely it can't get to 3%. Surely it won't get to 5%. Surely it won't go beyond that. And that just creates a complete lack of direction. So those bright lights which draw people, they're either exceptionally bright and they're following a trend which pre-existed and just hasn't been broken, like a NVIDIA type thing, or they're saying, well, all bets are off for the moment, so anything that's volatile, I'm just happy to keep my money out of. And if I had to boil that down into what happens in our equity market, ASX, and particularly the area that I look in, which is mining, stocks like BHP and Rio Tinto have tracked the ASX broader indexes. They haven't driven it; they've been a small part of it, but they've tracked the index, the ASX 100 for 12, 18 months, which is very unusual for them to do that. So I tend to think that the phenomenon that's driving the Australian market is, it's a common, investors are prepared to stick with it, but not to push more money into it and not to drag large amounts out. But then when you look down into small caps, micro caps, they're the ones that have suffered. So the underperformance has really occurred as you get into the smaller and more risky things. So I think that's where the confusion comes in. There's a great fundamental. There must be, because BHP has been going okay. Okay, well, how does that apply to junior explorers for copper or gold or anything else? Well, can you fund it? I'm a little bit concerned about that. So at the end of the day, I might not put my money in, I think is the question, is the way that a lot of people have answered that question. And you might also impute, well, if I've got a bit of stress on my mortgage and I'm thinking about whether something belongs in an equity or elsewhere, you might not liquidate your BHP, you might not liquidate your Woolies or your CBA, but you probably will liquidate your explorers in order to say, well, whilst the future's uncertain, I'll put them to work somewhere where it's reducing my interest burden or earning money for me.
Very interesting. Okay. So we touched on lithium briefly. Are there some standout commodities in this schizophrenic market that you think are more of a standout than others? Like the copper price is back a little bit, gold's been going sideways, silver's down a little bit, iron ore's off, and China's in a whole heap of trouble.
Yep. That's a good summary. I watch the copper price, so that interests me. I watch the copper price long term because I think you get a really good read off of the approaching economic cycle. And if you were to plot mining equities over a long period of time and just take an index like the ASX 100 Resources Index, most people can find that even on a Yahoo Finance. If you plot that long term versus the copper price, and the exercise is to say, all right, in the peak of 2007 and 8, what did I think mining equities are going to do, particularly driven by the sentiment of the street? And what you find is that those mining equities, you were thinking stronger for longer. This should go on. The long-term fundamentals are wonderful. What actually happens when you put those two side by side is that the copper price tends to lead the equities and not the other way around. So if the copper price is going to halve, your mining equities are going to go down. You can't defy that because commodity markets have tended to be quite strongly correlated for the last 40 or so years, and even more so in the last 20. In which case, you can't impute that one commodity is going to stand out or anything like that. But they can outperform and they can underperform. So the ones which interest me the most at the moment, copper has a wonderful long-term fundamental, and if someone comes along with a decent copper project at a decent price, I'm going to bite their hand off. I think it's a great place to be. And that is based on investing through a bottom. It's not because I think the copper price is going to have some upside to it in the next 6 months. I think it's probably got more downside than upside at the moment. Gold is a really interesting counter-cyclical, and I think it's someplace that, I know that your gold conference, Kerry, which is much more about that commodity, there's a lot of talk about having a portion of your portfolio specifically in gold, and not just because it's an interesting commodity, because it plays a part in wealth preservation and preservation of liquidity. Because at times when, I think most SAS soldiers would probably know this implicitly, and I know it's an interesting example to say it this way, but there was a time where Special Forces soldiers operating well behind enemy lines had a belt of gold sovereigns sold into their uniform, because if you need to buy yourself out of a situation, you're not going to do that with a barrel of uranium or a sheet of copper. You're going to do it with gold sovereigns. It's something.
Wow,
It's a
I
language
didn't
that gets
know
spoken
that.
everywhere in the world. So, but that's a really good example, right, of when things are tough, and that happens all the time in equity markets. If you plot the purchasing power of gold against your equities, you probably find that when the equities are falling, whilst gold would be weakening, it's still got a better purchasing power than your equities do. So that's one reason why I think people find it interesting. And I move away from that a bit and feel that, if gold is something which has such a unique financial quality, it's also something which it's worth being able to produce. And over the long term, and all the projects which we've ever assessed, quite aside of that quality of the commodity, it's also the easiest commodity to extract from the ground. It tends to be easy to extract, easy to sell, in which case it's a good place to manage the project technical difficulty risk of your portfolio against the rest of it by having some in gold. So always looking for gold things. And when there's uncertainty in the air, gold tends to have a whiff of positivity about it as well. So for me at the moment, gold has the ability to be constructive, which could mean anything, but I tend to think that gold's more up than down for me. I'm very interested in the opportunity which is presented by things like lithium or nickel, things that have been really smashed down by the commodity market. But that's not to say that I want to take a position in 20 things across one of those commodities. It's much more to say that creates really good entry points into the one or two of those that I want to do. So I'm happy to be very, very picky about the stock. But you've also got to take a slightly longer term perspective. I think when something's really been smashed, there's a sentimental factor that needs to be overcome for the market to support those things, as well as the reality to play out. So, if nickel was to bottom now, it still might be another 2 years before anyone in the equity market wants to believe that it's in an uptrend. So I'm looking very carefully at those, but worried about the sentimental transmission to equity prices.
That's an interesting point you make as well, because I mentioned right at the start that you guys are sitting on a bit of cash at the moment looking for opportunities. But one thing that I think is important that we haven't covered is that being patient. Rick Rule often says that a lot of investors these days, the attention span of, and I'm not quoting him, but as I say, but he's intimates that people have got the attention span of a gnat and they're not patient. And it's certainly, I think, in the industry that you cover, which is resources, patience is part of being a good investor, isn't it?
Oh, definitely. Yeah. I'm not sure I've ever actually seen a gnat. They're probably far more common in North America, but any small insect, they're probably more patient than a lot of investors, in that if you've ever been bothered by a mosquito at a barbecue or something like that, you're forever slapping the back of your neck trying to get rid of it, and it keeps coming back and coming back. So, those creatures are probably more patient in that they're so persistent like that. Whereas, there's a bright, shiny light, I should have some of that. And, I've sat at conferences numerous times. In fact, I've done this at your conference, Kerry, when a very prominent gold company based out of Sydney, headed up by a guy whose name starts with J, was making a presentation. And I got a lot of time for the evolution story and for Jake Klein. As he's telling his story, I'm getting my phone out and going into ComSec, and I was sitting there going, oh, I could put an order on here. And I chastised myself. I put that bloody thing away. That you're breaking your own first rule here. You've heard the story and you haven't gone and done anything about having a look at the homework or stripping away the marketing and looking at the fundamentals that he's talked to and then extrapolating those over a bit of time. And I think I did end up topping up on evolution after that conference, but it was having done a bit of work on it. So, patience is something that if you're prepared to back a concept, you can't assume that it's going to play out straight away. The payoff or the value realization process in mining, let alone in exploring, is never ever linear. It's not going to happen at a standard rate. So it's going to go like this before it goes like that, and that's what you need to prepare yourself for. So patience in terms of picking your entry point, Patience in terms of thinking there'll be multiple entry points that you probably need to top up at, and maintaining enough sensible liquidity to be able to do that, because you can guarantee that the time when you are least liquid and least able to follow your money or do something about an opportunity is going to be the point from which the greatest value could have been created. And that's probably got something to do with what it did to the price and what happened to the price afterwards.
Yeah, being able to take those opportunities when they arise. But, Hedley, we're running out of time. If I can ask you just quickly, if you could sum this all up and give our beautiful audience out there 3 things that they should probably be doing as part of their investing journey, what would you suggest they might be?
Yeah. Okay. Well, first one, one thing I get to do is get around and talk to loads of people, and there's no reason why this audience shouldn't either. And the best place you can do that is go to some conferences. These things are open to the public. Have a look around, but you probably, make your event in Sydney a starting point there. So, that's a shout out, but at the same time, it's a great bite, the cross section of the junior space that you get there. They're very well selected companies. So, and use that to educate yourself. Listen to their talks, talk to them afterwards, and listen to the topical presentations, which are designed to sort of help you with your overall macro considerations. So that's the first one. The second point would be, as you said, patience. You can't just sit there and say, well, that's a nice, bright, shiny light. I'm going to have a crack at that. You're not ordering a meal in a cafe here, because if you order something at a cafe and you don't enjoy it, well, you haven't committed your entire wealth to it. And secondly, you're going to be making that decision again in another 3 or 4 hours. So get over it, move on. But when you're making an investment, you are committing yourself to something for a long period of time, and knowing why it is that you've got invested into it is just as important as your price and all the rest of it, because you need to understand from that point how you're going to get out of it. So flowing from that, using patience to go through that process, and knowing that if you miss one, there's going to be plenty of others. Just relax. You miss one that heads for the sky, there's going to be another one within 2 weeks. I promise you that. And I suppose the third thing, which kind of plays to both of those, is diversity. You can't pretend that you're going to be able to make one investment in this space or in any space in the equity market that is going to be the one investment that you should have made. You need to have diversity across any form of financial portfolio. And I think if you were just limiting that to your view into the exploration come junior mining space, you definitely need diversity, because these companies have problems just as frequently as they have good marketing stories. So you need to guard yourself against that, and try as best you can to have more than one commodity, certainly more than one management team they're exposed to, and more than one funding outcome. And that's we're a listed company that diversifies ourselves. So I'm eating my own cooking here. We attempt to do that very thing, and that's the best suggestion I can give you if you're going to invest in this space, is try to have diversity, because if you don't get it right, and you won't, we don't all the time, when you do get something right, you want to make sure that your net has captured that 1 or 2 things, so that the rest of your performance can benefit from it.
And if I can finish up by saying, as an investor, as a shareholder of a company that is listed, you are a part owner. So never, ever feel that you can't call that company up and ask them how they're spending your hard-earned cash, because Absolutely. After all, you're part of that company. So I find quite often, Hedley, that people are they don't reach out and ask the questions because they either don't know what to ask, or they don't think that they're important enough. I think everybody that's a shareholder is important.
Well, the best test is whether or not they can answer that question, Kerry. So if you call a company and they seem shirty with you, or they don't answer the question to your satisfaction, then the most obvious conclusion is that you shouldn't be holding that equity, and you should put it into a situation where they can answer that question. So, that if you're afraid to ask the question, you might never get that answer, which is a good thing to know.
What a fantastic way to finish up our conversation. Hedley Widdup, it's always fabulous to speak to you. Lion Selection Group, the ASX code, as I stated at the start, is LSX. Hedley, thanks so much for joining me on Making Money Matter.
Thank you, Kerry, and I'll see you in Sydney in August.
Excellent. Look forward to it. Thanks, mate.